Sound check, sound check, check. Check. Good morning, students. Good morning, good morning, good morning, good morning. Good morning, everyone. Good morning. The time has come that we continue further, and we are doing your next part, and that is going to be your capital structure theories. Okay. So, are you guys ready now? Okay. Capital structure theory. Okay. Okay, fine. Now, my dear students, yesterday we completed your cost of capital chapter. Okay. Now we are starting with your capital structure theories. Now see, my dear students, whenever we deal with your capital structure theories, okay, there are some few concepts which you have to first understand. The first one is, what is the objective of capital structure theory? Now the objective of capital structure theories actually is to check whether change in capital structure will have an impact on your WACC or not. So there are some theories which tells you that even if you change the capital structure, your WACC will change. And there are some theories which tells you that even if you change the capital structure, your WACC is not going to change. Okay? So see, it is something like this. Let's say, for example, there is debt and equity in the capital structure. Okay? Now let's say the proportion of debt is 20% and the proportion of equity is 80%. Suppose the cost of debt is 10% and the cost of equity is 15%. Can you all please tell me what is going to be the overall cost of capital? Can I say this will be 0.2 into 10%? It will be nothing but 2%. 0.5 into 8 will give you what, beta? 12%. What is the overall cost of capital, everyone? 14%. My first question to you is, when the debt is 20% and when the equity is 80%, your KO is coming as how much, beta? It is coming as 14%. So I'm asking you, if I change the capital structure, it means, what do I do? If I change the capital structure means, if I put here 50% debt and 50% equity, what do you think will happen to the overall cost of capital? Will it remain the same or will it change? Of course, it will change. It can rise also, it can fall also. Okay? So there are some theories which tells you that even if you change the capital structure, your WACC will remain the same. And there are some capital structure which tells you that if you change the capital structure, your WACC is not going to change. Okay. So what is the objective of capital structure theories? The objective of capital structure theories is to check that if you change the capital structure, will it impact or your WACC or not? What do you think is your view? Change the capital structure. What do you think is your view? Should the WACC change or WACC should not change? It should change, right? But there are some theories which support that even if you change the capital structure, your WACC is not going to change. So we will see. In all, there are 5 theories, capital structure theory. How many theories are there, beta? 5 theories. Now, every theory based on certain assumptions. Now, these capital structure theories is also going to be based on certain assumptions. Now, the assumptions are, first of all, there is no income tax. Okay? So, capital structure theories are built in a no tax world. So, will you see any income tax or there is no income tax? But no income tax. Whenever you will study capital structure theories, you will realize that there is no income tax at all. The second assumption is that there is no preference share capital. So, That's why only there will be two sources in the capital structure theory. What will be the two sources in the capital structure theory, beta? There is going to be debt and equity. Then the third assumption is there is no retention. There is no retention. What does it mean, beta? It means your 100% dividend payout ratio. So these are the three assumptions on the basis of which your capital structure theories are created. Okay. What is the first assumption, beta? No income tax at all. Okay. Second assumption is what? There is no preference shares at all. Okay. And the third assumption is what, beta? There is no retention. There is 100% dividend payout ratio. Okay. No retention, 100% dividend payout ratio. Now, based on these three capital structure assumptions, these theories are created. Okay. The first theory which is created is called as your net income approach. What is it called as, beta? Net income approach. Now, net income approach was created by Dividend, and net income approach tells you that even if you change the capital structure, your WACC is not going to change. What does net income approach tells you, beta? If you change the capital structure, will your WACC change? Net income approach tells you that if you change the capital structure, your WACC will change. My approach tells you that if you change the capital structure, will the WACC change? Come on, yes or no? Yes, sir. Tells you that the WACC is going to change. How? He tells you very simply that, see, if suppose there is debt and equity in the capital structure. What is there in the capital structure, beta? Debt and equity. Okay. And suppose this is 0.2 debt, equity is 0.8. Suppose cost of debt is 10%, cost of equity is 15%. Can you please tell me what will be the WACC, beta? This will be 2%, this will be 12%, total KO is what, beta? 14%. Now, amongst debt and equity, which is a cheaper mode of finance? Debt is a cheaper mode of finance. Okay? So, when you introduce more debt in the capital structure, suppose I have introduced here more debt in the capital structure. Okay? So, now can I say this is 0.4 into 10, this will be 4%, 0.6 into 15, this will be what, 9%. Then the overall cost is what, 13%. What has happened to the KO, beta? Has the KO reduced? Come on, yes or no? Yes, sir. So, due to your change in the capital structure, is it having an impact on your WACC? Come on, yes or no? Yes, sir. What is happening to the WACC, beta? Is the WACC rising or the WACC is falling, beta? And it is falling. And from 14%, it has become how much, beta? 13%. He says that even if you introduce more debt in the capital structure, then what is going to happen to your WACC? Now, can I say this is 6%? This will be your 6% again. So, this will be your 12%. What has happened to the overall cost of capital? Has it increased or it has decreased, beta? It has decreased. Because see, debt is a cheaper mode of finance. If you keep on introducing more and more debt in the capital structure, then what happens to the WACC, beta? Will the WACC rise or the WACC will fall? And the WACC keeps on falling. So basically, what does Dividend tells us that in the net income approach, more and more debt introduced in the capital structure will lead to fall in your overall cost of capital. Now, what happens when the cost of capital of the company falls? When the cost of capital of the company falls, it means market value of the company falls or the market value of the company rises. So can I say the market value of the company is maximum in this particular part? Come on, yes or no? Yes, sir. Market value of the company is maximum. Why? Because overall cost of the capital is minimum. When the cost of capital is minimum, don't you think that the returns of the company will be higher? And when the returns of the company will be higher, what do you think will happen to the market value of the company, beta? Will it fall or it will rise? Rise. So, Dividend tells us one very simple concept, that debt is a cheaper mode of finance. If you keep on introducing more and more debt in the capital structure, then the overall cost of capital of the company will fall. You just introduce more and more debt in the capital structure. Keep on introducing debt in the capital structure, your debt is a cheaper mode of finance, then your overall cost of capital will reduce. So does he support the view that if you change the capital structure, is the WACC changing? Come on, yes or no? Yes, sir. He supports this view. If you change the capital structure, your WACC is going to fall. But there is a problem in this capital structure theory. There is a disadvantage. There is a wrong assumption in this particular approach. Can you tell me what do you think is the mistake, or there is a wrong assumption for NI approach? No. The problem is, that when you keep on taking more and more debt in the capital structure, the risk in the company increases. And if the risk in the company increases, what do you think happens to the KE beta? Do you think that the KE should remain the same? The KE should fall, or the KE should rise beta? The KE should rise. So basically he considers that the KE should be kept constant. What does he consider beta? KE should be kept constant. So under NI approach, will the KE remain the same at all levels of debt in the capital structure? Come on, yes or no? Yes, sir. But do you think that this is correct or this is incorrect beta? Incorrect, because when you keep on introducing more and more debt in the capital structure, then can I say that keeping more and more debt in the capital structure increases the risk in the company? And if it keeps on increasing the risk in the company, then can I say that the KE should also increase? Come on, yes or no? Yes, sir. But NI approach tells you that the KE is going to remain constant at all levels of debt in the capital structure. Okay? So the first approach is which approach beta? NI approach. And NI approach tells you that if you change the capital structure, will the WACC change? Come on, yes or no? Yes, sir. But here what is the assumption? That the KE remains constant. Okay, so this is slightly not correct. Okay. And when the KO keeps on falling, can I say that the market value of company, what happens to the market value of the company beta? Keeps on increasing. But then came another approach. Another approach was your traditional approach. Now in your traditional approach, they support the view that if you change the capital structure, the WACC should change. Okay. If you change the capital structure, should the WACC change? Yes or no? Yes, sir. But traditional approach tells you that the KE will not remain constant. If you keep on introducing debt in the capital structure, will the KE fall or the KE will rise? KE will rise. Of course, KE will rise initially marginally, but subsequently drastically. And the KE will rise in such a way, that benefit of cheaper debt will not be available to you. So then the KO will be kept on increasing only. So what does this traditional approach tells you? Suppose there is debt and equity in the capital structure. Suppose the proportion of debt is 0.2 and proportion of equity is 0.8. Suppose this is 10% and this is 15%. Can you give me what is your overall cost of capital? 2%, 12%. What is the overall KO beta? 14%. Now if you introduce more debt in the capital structure, suppose if I introduce more debt, it means I take debt of 0.4. Can I say my equity will be 0.6 beta? Okay. Now this will be what? 0.4 into 10, 4%. Okay. So they tells you that no, the KE will increase. It will increase initially marginally. It means that, let's say for example, this becomes 15.5%. Now can you tell me 0.6 into 15.5 becomes how much beta? 9.3%. Now can you tell me what is the overall cost of capital? 13.3. Guys, what has happened to the KO? Has the KO increased or the KO has decreased beta? So now see, is the KE also increasing? Yes or no? Yes. But you are getting the benefit of cheaper debt. But for example, if you keep on introducing more and more debt in the capital structure, suppose you tell no, I want this to be 0.6 and I want this to be 0.4. Now can I say this is 0.6 into 10, this will now become 6%. But now the KE will increase in such a way that the benefit of cheaper debt will no longer be available, the KO will increase. So in this particular case, suppose this is becoming now 30%. Now can you please tell me 30 into 0.4 is what beta? 12. Now 12 plus 6 becomes how much beta? 18%. Now my question to you is, what has happened to the KO? Has the KO increased? Come on, yes or no? Yes, sir. Now is the benefit of cheaper debt available or it is not available beta? It is not available. So what does traditional approach tells you that, listen, if you want to introduce debt in the capital structure, you introduce the debt in the capital structure up to an extent that the KO is optimum to you. The KO is optimum to you. Matlab, this is the lowest KO. But if you keep on introducing more and more debt, then the KO will increase in such a way that the benefit of cheaper debt will no longer be available and your market value of the company will fall. So can I put it like this, that here the KO will become how much beta? 13.3%. Hello? The KO becomes how much beta? 13.3%. And can I say that here the market value of the company will be maximum? Come on, yes or no? Yes, here the market value of the company is maximum. Okay, here the market value of the company is maximum. So you should actually stop here. Okay, you should not take anything more than that. But if you think, no, yaar, I want to take more and more debt, I want to take more and more debt in the capital structure, then what is the consequence, beta? The consequences is such that will the market value of the company be affected? Come on, yes or no? Then the answer is. So my very simple question to you is that what do you think happens to the KE under the traditional approach? Does the KE remain the same? The KE falls or the KE rises, beta? The KE rises, but initially marginally, subsequently drastically. Okay, in such a way that your benefit of cheaper debt gets compensated by the benefit of cheaper debt. You know, it is available up to an extent, but if you keep on taking more and more debt, then the KE will rise in such a way that then there is no longer benefit of debt available to you. Are you guys trying to understand this? Okay. Very good. So this is which approach beta? Traditional approach. I want every one of you to now please tell me very fast and very quickly that under your first approach, the first approach which is your NI approach. Everyone please tell me, under your NI approach, what do you think happens to your KO? Will the KO be kept on falling? Come on, yes or no? Yes, sir. Okay, it will be kept on falling, it will be kept on falling, it will be kept on falling. Okay, because is there any change in K or K is remaining constant beta? K is remaining constant. Under traditional approach, will the K remain constant? No. Will the K increase? Come on, yes or no? Yes, sir. Initially, marginally, and subsequently in such a way that you will no longer get the benefit of cheaper debt. Then there is one more approach beta, and that is actually called as your net operating income approach. What is the name of this approach beta? Net operating income approach. Now what do you think happens in the net operating income? In the net operating income approach, the KE will actually increase exactly in such a way that benefit of cheaper debt gets compensated. So is the KE going to increase? Come on, yes or no? Yes, sir. But it will increase exactly in the same way that benefit of cheaper debt gets compensated. It means that this approach tells you that the change in capital structure will not impact your WACC. What does this approach tell you beta? The change in capital structure will not impact your WACC. Is your WACC going to remain constant? Come on, yes or no? Yes, sir. Your WACC is going to remain constant. So whatever is the benefit of cheaper debt, that actually gets compensated with what beta? That gets compensated by rise in KE in such a way that the KO is going to remain constant. So my dear students, under your net operating income approach, will your KO remain constant? Come on, yes or no? Then the answer is yes. KO is going to remain constant. Okay. What was your first approach beta? NI approach. In net income approach, what was remaining constant everyone? KE. What was the second approach guys? Traditional approach. In traditional approach, was the KE increasing? Come on, yes or no? Yes, sir. What is the third approach? Net operating income approach. In net operating income approach, is the KE going to remain constant? No. Is the KO going to remain constant? Yes. But KE will increase in such a way that benefit of cheaper debt is compensated. So at all levels of debt in the capital structure, will the KO remain constant? Come on, yes or no? Yes, sir. See, let's say for example, this is debt and equity in the capital structure. Suppose there is 0.2 debt, 0.8 equity. What is the total? 1. Suppose this is 10%, this is 15%. Then this will become 2%, this will become 12%, this will become what? 14%. Is the KO 14%? Yes or no? Yes. Now he says that at all levels of debt, the KO is going to remain what? Constant. And what is the constant rate, beta? 14. How is this going to remain constant now? Suppose you take more debt in the capital structure. Okay, suppose I take 0.4 debt in the capital. Then can I say 0.4 into 10 will become how much, beta? 4%. So this will exactly be 10%. Okay, the balancing figure of this should be what? 10%. Because the KO is going to remain constant. Now, can you tell me if this becomes 10%, how much will the KE become? Can I say 0.8 into something gives you 10? Right? 0.8 into X will give you 10. So now if I want X, what will I have to do, beta? 10 divided by 0.8. Right, this will be going to be 0.6. Okay, so this is 0.6 into X will give you 10. So if I have to take 10 and divide that by 0.6, this will become what, beta? 16.67. Is the KE increasing? And KE is increasing exactly in a way that is your debt, is your KO remaining constant? Come on, yes or no? Yes, sir. The benefit of cheaper debt gets compensated with the rise in. That is actually your which part, beta? NY approach. Okay, so KO remains constant. Okay, so now I am taking one more debt in the capital structure. Now let me take one more debt, 0.6, 0.4. Now you guys only tell me. If this is 0.6, then this will become what, beta? 6%. Then this will become what, beta? 8%. Now can I say this will now become 8 divided by 0.4. How much is this going to be, beta? 20%. My simple question to you is the KE increasing? Come on, yes or no? Yes, sir. But the KE is increasing in such a way that the KO remains constant. The benefit of cheaper debt gets compensated by the rise in the. Now, can you all please tell me what will happen to the market value of the company? Can I say the market value of the company is going to remain the same? It remains the same. It remains the same at all levels. The market value of the company remains the same at all levels. The market value of the company is not going to change. Is the market value of the company going to remain the same at all levels of debt? Come on, yes or no? Yes, sir. So guys, this is what is your NY approach. Okay. Everyone will now repeat with me again one by one. First point. What was the first approach, beta? Under NI approach, is the KE remaining constant? Under NI approach, what happens is the KE remains constant. Okay. Can I say that if you introduce more debt in the capital structure, what will happen to the KO? It will decrease. And what do you think happened to the market value of the company? Increases. Under traditional approach, what do you think? Is the KE going to remain the same or the KE is going to increase? KE is going to increase. And the KO will fall initially, but it will rise subsequently. So market value of the company will increase initially, but the market value of the company will fall. And then the next approach is your NOI approach. Is the KE going to remain constant? No. Will the KE increase? Yes. But what will remain constant? KO. And can I say market value of the company will also remain constant? Are you all okay with this much part? Okay. Now, my dear students, this is your first three approach. If you want to make a check. Okay. Are we done till here? Now, we will do first some questions. Okay. On one approach each. So I want you all to please come to your very first question. Now see what is given to you. ABC is expecting an EBIT of rupees how much beta? 2 lakhs. And the company in its capital structure has rupees 8 lakhs in 10% debentures. The cost of equity or the capitalization rate is nothing but 12.5%. You are required to calculate the value of the company using what? NI approach. Also compute the overall cost of capital. And if the firm borrows another 2 lakhs, calculate the revised value of the firm and the overall cost of capital according to NI approach. I want everyone to focus properly. Please tell me that what is your EBIT? 2 lakhs. So now let me write down first. This is the question on NI approach. What is my EBIT beta? 2 lakhs. From EBIT what do I subtract? Interest. What do I get beta? EBT. Right? Please tell me, is there any tax in capital structure theories? So this EBT itself will become NPAT. Is there any preference share capital in capital structure theories? No. So this itself is your net profit for equity shareholders. Can you please tell me, is there any equity, is there any retention in the capital structure theories? No. So 100% dividend payout ratio, can I say whatever is the profits available, that itself is your equity dividend. Correct? So this is the basic approach. Now please tell me that in the question, what have they told you that the company has the capital structure of what? 8 lakhs, 10% debentures. So if I have 8 lakh, 10% debentures, can you give me the amount of the interest beta? 80,000. So will you all please give me what is the EBT beta? 1 lakh 20. Are you all okay with this much part? Okay. EBIT minus interest, EBT, and that is coming as 1 lakh 20,000. That's your dividend. So this is going to be 1 lakh 20,000. Are you all okay with this? Okay. Now, what have they told you? The cost of equity or the capitalization rate is 12.5%. So what's your KE, everyone? 12.5%. You are required to calculate the value of the firm according to NI approach. Now, how do you calculate the value of a firm, value of a company? See, yesterday, do you know we did market value weights? Market value weights, we wrote sources of funds, then we wrote amount, right? Then we wrote weights, then we wrote COC, WACC, right? Suppose the source is debt and equity. And Shriram, if I write down the market value of debt as 10 lakh and the market value of equity is 15 lakh, can you give me the market value of the company? No, total market value of the company, 25 lakhs. Total market value of the company is 25 lakhs, right? So what is market value of the company? Can I say market value of the company is nothing but market value of debt plus market value of equity? What is market value of company? If you take market value of debt and market value of equity together, combined will give you market value of the company. Come on, yes or no? Yes. Okay. Now tell me one thing. If you just check, do you have the debt value available? Yes or no? Yes. What is the value of the debt, beta? 8 lakhs. Can I say value of debt is 8 lakh rupees? Have they given any market price of preference share or debenture or etc. something like that? No. When there is no such data given to you, can I say book value itself is nothing but your market value? So can you all please tell me what is the market value of debt available, beta? 8 lakhs. Okay. But I don't have market value of equity. How do I calculate market value of equity? Using KE. Very good. What is the formula for KE in your dividend yield approach? No, dividend yield approach, not dividend yield growth approach. DPS by MPS. Hey, you all know this, na? Yesterday we did it. So that was DPS by MPS into 100. Correct? If I want to find out in totality, can I write down KE is dividends upon market value of equity into 100? It's the same thing, na yaar. If I take on per share basis or if I take it on your totality basis, is the answer going to be the same? Come on, yes or no? Yes, sir. So it's dividend upon market value of equity into 100. Now I want market value of equity. Can you guide me? How will I do market? Can I say you have dividends available? What is the dividends available, guys? What is the dividends available? 1,20,000. So if I have dividends available and if I have KE available, can I get the market value of equity? Come on, yes or no? Yes, sir. So can you all please tell me what is market value of equity? Dividends upon KE. Right? What was your dividends, guys? 1,20,000. What's your KE? 12.5%. If I take 1,20,000 and divide by 12.5%, what will I get, beta? 9,60,000. So is 9,60,000 your market value of equity? Come on, yes or no? Yes, sir. So what is the market value of the company, everyone? 8 lakh plus 9,60,000 is what? 17,00,000. This is the market value of company. Okay. So can I take dividends upon KE to get dash? Market value of equity. Okay. That's the first thing they had asked. And the second thing they had asked was, you are also required to calculate what, beta? Overall cost of capital. Overall cost of capital. What is overall cost of capital? We are required to calculate your KO. What is required to be calculated, beta? KO. Okay. Now see. One of the way to calculate the KO is, you know what? As we do it normally, by taking sources, amount, weights, cost of capital, WACC. Is that one of the approach to calculate your KO? Come on, yes or no? Yes, sir. Can you please give me what are the two sources of fund? Debt and do I have its market value? Come on, yes or no? Yes. What is it? 8 lakhs and 9,60,000. So can I say that is 17,60,000? Okay, so if I take 8 lakh and divided that by 17,60,000, then I'll be getting what, beta? 0.45 and 0.55. Total should be 1. Do I have the cost of debt available? Yes or no? Yes, that's 10%. And cost of equity is 12.5. Can I say 10 into 0.45 will give you 4.5? and this is 0.55 into 12.5. So this will give you what? 6.875. And if I add both these things, can I say you will be getting 11.375? But you know what? That whenever there is a no tax world and whenever there is 100% dividend payout, you know what? You can just calculate KO by using this formula also. And you know what is the formula? You just take EBIT and simply divide by market value of company into 100. You just take EBIT and divide that by what? Market value of the company into 100. You will be getting the same answer. What's the EBIT which we calculated? 2 lakhs. What's the market value of the company? 17 lakh 60. Take 2 lakh and divide that by 17 lakh 60. Are you getting the same answer? How much is that? 11.3637 whatever, approximately. So whenever there is no debt in the capital structure, what should you? Whenever there is no tax, then what should you do? Can you calculate KO by using the normal formula? Come on, yes or no? Yes. Okay. So my dear students, what I'm trying to make you understand is under NI approach, this is how you calculate what should be the KO, what should be your market value of the company. Now, if you have understood this concept now, then you can tell me something like this. Guys, please tell me, if the firm borrows another 2 lakhs, are we introducing more debt in the capital structure? Now, I want every one of you to, if the company introduces more debt in the capital structure, then will your KE increase under NI approach? Yes or no? Yes or no? Very good. It's going to remain constant. Then can you all please, what do you think will happen to the KO? Should the KO rise or the KO fall? KO should rise or KO should fall? Fall. Why? Because debt is a cheaper mode of finance, right? And when you keep on introducing more and more debt in the capital structure, what do you think happens to the KO beta? Will the KO fall? Come on, yes or no? Yes. And if the KO falls, what do you think happens to the market value of the company? Will it fall or it will rise? The same. It's going to happen now. Are we introducing 2 lakh rupees debt in the capital structure? Come on, yes or no? Yes, sir. Now see, as you have told me, yes, sir, KE is constant. Okay, KE is constant. Then your KO will fall and the market value of the company will rise. You will see all the things happening now. What's the format of the income statement? Minus interest. What do you get, everyone? EBT, also known as your dividends. Come on, yaar. Do you have EBIT available? Yes or no? Yes, 2 lakhs. How much more debt you have taken in the capital structure? 2 lakhs. So old was how much? 8. New is what? 2. Total is what? 10. 10 lakh multiplied by 10% will give you what? 1 lakh. This will be what? 1 lakh. Are you okay with this? Okay. So this is 1 lakh. Now please tell me, everyone, how do you calculate your market value of company? What's the formula? Market value of debt plus market value of equity. What is market value of debt? 10 lakhs. How do you calculate market value of equity? We take your dividend and we capitalize that by K. What was your dividend beta? 1 lakh. What's your KE beta? 12.5%. Can I say this is 8 lakhs? 10 plus 8 will give you what? 8. Can you all please tell me what was your old answer? Old 17 lakh 60. What do you think has happened here? 18 lakhs. As the market value of the company. And if the market value of the company increases, then what happens to the? Let us check that also. Now I will not prepare a table. Can I use a formula, beta? Yes, sir. EBIT upon market value of company into 100. If I take 2 lakh and divide by 18 lakh into 100, how much is this? 11 point. From 11.37 it has. Under NI approach, always remember like this. that if you keep on introducing more and more debt in the capital structure, because debt is a cheaper mode of finance, what do you think happens to the KO? Will the KO keep on falling? Come on, yes or no? Yes, the KO will. And the market value of the company will rise. But here, what is the wrong assumption which David Durant has made? That he has kept dash constant. He has kept dash constant. Tell me, what has he kept constant? Can I say he has kept KE constant? Come on, yes or no? Yes, sir. What do you think the KE should? The KE should increase? Come on, yes or no? Yes, sir. And that's why we have now one more approach which is now called as traditional. You can ask me, should we? No, only if they ask you. They ask you like this, that what is the market value of the company, then it is evident that you calculated the old market value which is 1760. The new market value is 18 lakhs, old KO is 11.3 and new KO is 11.11. So it gets proved automatically. Can we now start with the traditional approach? Okay. Traditional approach. Let's start. What will happen in the traditional approach? Will the KE remain the same? The KE will increase. XYZ is expecting an EBIT of rupees 3 lakhs. The company presently raised its entire fund requirement of rupees 20 lakhs by issue of equity at a capitalization rate of 16%. The firm is now contemplating to redeem a part of the capital by introducing debt finance. The firm has two options to raise the debt, to the extent of 30% and to the extent of 50% of the total fund. Can you all please answer this in one voice? At present, is there any debt in the capital structure? At present, is there any debt in the capital structure? There is no debt in the capital structure. Are we introducing debt in the capital structure? Come on, yes or no? Yes, sir. So at present, whatever is the KE, do you think that subsequently the KE is going to remain the same? The KE will fall or the KE will rise? KE will rise, as in when you are introducing more and more debt in the capital structure. They have told you that the firm has two options to raise debt, 30 and 50%. It is expected that for debt financing up to 30%, the rate of interest will be 10 and the KE is expected to increase. Right? Is this approach rectifying the earlier approach? Come on, yes or no? Yes, sir. And this increases to what, beta? 17%. If it opts 50% of the debt, then the interest rate will be 10 and the capitalization rate will be 20. Are you again seeing that the KE is increasing? Old KE was 16, 16 to 17, 17 to 20. Are you seeing that there is rise? Come on, yes or no? Yes, sir. You are required to compute the value of the firm and the overall cost of capital under different options. Even if they don't mention this, my students knows which approach is this. Traditional approach, because KE is not. Right, beta? How will we proceed now? We are required to calculate two things. What are the two things required to be calculated, beta? What is the value of the firm and what is going to be your overall cost of capital? Everyone please eyes on the screen. How many options do we have? 3. In the first option, what was the amount of debt? 0. In the second option, what's the amount of debt? 30% of the total funds. Total funds is 20 lakhs. So can I say this will be 6 lakhs? Solo yaar. And in the third option, what's the amount of the debt? 20 lakhs and we are taking 50%. So this is going to be what? 10 lakhs. And do you have any KE available to you? Question? Yes. What was the earlier KE? What was the KE? What was the KE? 16. But guys, then the KE increases to 17. Then the KE becomes 20. Okay. What's the format of the income statement? What will you get? EBT, also known as dividends. What is the amount of EBI? What is the amount of EBI? 3 lakhs. This is 3 lakhs. Lakhs. In the first case, is there any? No. Why? Because is there any debt, beta? No debt. There is no interest. So can I say this is going to be 0? So this is going to be 3 lakhs. Come on, yaar. In the second case, is there any debt? Will there be any interest? Can you please tell me what is the interest percentage? They have told you the interest percent. What is the interest percentage? 10%. So can you please give me 6 lakhs 10%? 60,000. So this will become what? 2 lakh 40,000. In the third case, what is your rate of interest? Your rate of interest is 12%. So 12% of 10 lakh is what? 1 lakh 20. So this will become 1 lakh 80,000. With this income statement, Purinjita. Now we are required to calculate two things. What are the two things which are required to be calculated? Market value of firm and what is going to be your KO. How will you calculate market value of debt plus market value of equity? What is market value of equity, everyone? Dividends upon KE. In the last question, Sriram told us that K is DPS upon MPS into 100, right? So we can write down total dividend upon market value of equity into 100. So if I want to find out market value of equity, can I do that? Come on, yes or no? Yes, by taking dividend and capitalizing that by K, right? Everyone please tell me, do I have the dividends? 3 lakhs, then 2 lakh 40, then 1 lakh 80. Then we have to divide this with what, beta? K. Give me the first K. 16, then 17, then 20. Give me market value of 18 lakh 75,000, then 14 lakh 765, and the last one is 18 lakh divided by 20%. 9 lakhs, na? Do I have market value of debt? Yes. This is 0. This is 6 lakh. This is 10 lakh. Now, can you please give me what is going to be the total market value? 18 lakh 75. This will be 20 lakh 11,760. 19 lakh. Correct? Now, what is the formula for KO every? EBIT upon market value of company into 100. Market value of firm or market value of company is the. Can you give me EBIT beta? 3 lakhs. 3 lakhs. Do I have market value of the company? Yes. 18 lakh 75, 20 lakh 11,765 and 19 lakhs. So the first percentage will be 16. Okay, the second percentage will be 3 lakh divided by 20 lakh 11,765. Give me what is this? 14.91%. The third percentage will be 15.79. So first it was 16. From 16 it has reduced to 14 and then again it has started increasing. What is the optimum capital? Can I say this is the optimum capital? This is the best capital. We can ask you in MC, which of the following approaches helps you to understand the best capital? NI approach, NOI approach, additional approach, or MM approach? Then the answer is what? Will help you to best capital. Everyone got this? Hello? You all understood this beta? Sure? Confident? Now we were done with which question beta? Question number 2. Now I want you all to please come to I did one question on traditional, one question on NI. Now I am solving one question on NOI approach. Okay. This question, will you help me to solve this? Okay. Chalo. ABC is expecting an EBIT of what? 4 lakhs and it belongs to the risk class of what? 10%. You are required to find out what should be the value of the firm and the cost of equity if it employs 8% debt to the extent of 20%, 35% or 50% to the total financial requirement of 20 lakhs. Use NOI approach. Now this is your question number 4. Okay. Which approach are we going to use beta? NOI. How many options do we have? Three options. Okay, option 1, option 2, option 3. Everyone please give me, what is the total fund requirement beta? 20 lakhs. In the first option, if the total fund requirement is 20 lakhs, how much is the debt beta? How much is the debt? 20%. So this will become what beta? 4 lakhs. Then in the second option, if this is 35% of 20 lakhs, what is this going to be beta? 7 lakhs. And in the third case, what will be the amount of the debt? Can I say this will be 10 lakhs? Are you all okay with this? What are the three proportions? Which approach is this? What will happen to the KO? At all levels of debt in the capital structure, will the KO remain constant? Come on, yes or no? Yes, sir. And market value of the company is also going to remain constant. From EBIT, what do I subtract? What do you get? EBT, right? And that EBT, we can also say, is your dividends. What is the amount of your EBIT? 4 lakhs. 4 lakhs. 4 lakhs. Do you all agree with this? Okay. Can you give me the amount of interest? Can I say amount of interest is what? 8%. Give me interest here, 4 lakh 8%. Give me 7 lakh 8%. And 10 lakh 8%, 8. This will now be 4 lakh minus 32. 3 lakh 8. Give me 4 lakh minus 56. And this will be correct. Now please tell me, we are done with this much part. Okay, now please tell me that we are required to find out value of the firm. How do you find out market value of firm? We find out market value of debt plus market value of equity. Please tell me, do you have market value of debt available? But do you have market value of equity? No, you don't even have capitalization rate available. Rather, that needs to be calculated. KE is asked to be calculated in the question. Come on, yaar. That's what they have told you. So KE is also not available in the question. Now, in such a situation, what should I do? Yes, anyone? How will I calculate market value of the company? What is given to you? Tell me. KO. Yeah, Shriram, Rahul, you are right. KO is given to you, right? And KO is given to you, and what next is given to you? EBIT is available. So don't you think I can calculate value of the firm by taking what? EBIT upon KO. EBIT upon KO will give you market value of the company, na yaar? You all have not understood. What is KO formula, everyone? Upon market value of firm into 100. For the first time, I have the KO available. And I also have the EBIT available. What will be market value of firm, guys? EBIT upon KO. Do you all agree with this? EBIT upon KO, guys. Okay, will that give you market value of the firm? Come on, yes or no? Yes. And will the market value of the firm remain constant everywhere? Come on, yes or no? Okay, so what is market value of the firm? Can I say that will be 4 lakh? Divide that by 10%, 40 lakhs. Because that's EBIT upon KO, na yaar? Hello? EBIT upon KO. So this is 40 lakhs, this is 40 lakhs, this is 40 lakhs. Any doubts till here, beta? Now, what is the market value of debt, beta? 4, 7 and 10. So this is 4 lakh, 7 lakh and 10 lakhs. Am I in the position to calculate market value of equity? What is market value of equity? 36 lakhs, 33 lakhs. If I have market value of equity, now can I calculate KE? What is the formula for KE? DPS upon MPS or dividend upon market value of equity. And everyone just check and tell me, what do you think happens to the KE? KE will be in the first case 3,68,000. Divide that by 36 lakhs into 100. What is this beta? 10.22%. Then if this is 3,44,000, divide that by 33 lakhs. This will be 10.42%. And then this is 3 lakh 20, which I need to divide by 30 lakhs. 10.67. What do you think is happening to the K? And guys, the K is increasing in such a way that benefit of cheaper debt gets compensated. Whatever we are doing theoretically, we all are able to prove it practically. All the questions. All the three approaches we have done, not only the approaches, examples, but also the one practical. Have you all understood this? Okay. But now comes students' favor. Do you know approach? Have you heard about approach? Approach without tax and with tax. First, I'll be teaching you approach without tax. Do you know the concept of arbitrage? Arbitrage. So we are going to use the concept of arbitrage for calculation of your approach. So this I'll explain you very quickly. Now, first of all, what does tells you? Tells you that suppose there is a levered company. Do you know what is levered company? A company in which there is risk. That is called as a levered company. The levered company always has debt in the capital structure. And there is something which is called as unlevered company. Unlevered company means there is only equity in the capital structure. Guys, levered company has what? Debt in the capital structure. Unlevered company has only equity in the capital structure. So says that both the companies are having different capital structures. Come on, yes or no? Yes, sir. But says that if both the companies are identical in nature, it means if both the companies have the same EBIT, then value of both the companies should be the same. What does tells you? That the value of both the companies should be the same. So he says that value of levered company and value of unlevered company both should be the same. What? Like yes. Value of levered company and value of unlevered company should be the same. So I told him that how can value of two companies be the same? He says that is the EBIT same? I said yes. So he said that subsequently value of both the companies is going to be the same. But I just told him, listen yaar, this levered company value is 2,40,000 and the unlevered company value is 1,80,000 right now in the market. Levered company value is what? 2,40,000 and unlevered company value is 1,80,000. Why are you telling me it's going to be the same? Tells that this is going to be the same with the concept of arbitrage. In arbitrage, can I say there are some sure profits which you are going to earn? And in pursuance of earning those sure profits, you will start selling overvalued company and you will start buying undervalued company. And there will be a point where value of both the companies will be the same. Which one is the overvalued company here? Which one is the overvalued company? Levered or unlevered? Levered is overvalued. Which one is undervalued, beta? Unlevered. So people will start selling which company shares? Levered company. And they will start investing in which company shares? Unlevered company. So for sure, will there be any profits? Come on, yes or no? Yes, sir. And that profits is called as arbitrage profit. So when you will be start selling levered company, what will happen to its value? Its value will start falling. When you start buying unlevered company, what do you think will happen? The value will start increasing and there will be an equilibrium point where both the values will be the same. And if the value is the same and if the EBIT is the same, then can I say the KO will also be the same? Yes or no? Yes, sir. Well, I have not done earlier. Because if you are doing this for the first time, it will be little bit, tricky for you. But I'll try to explain in the simplest format. See, what is arbitrage profits? Do you know? Arbitrage profits in general means to buy from a place where it is cheap and to sell at a place where it is expensive. It means sell expensive, buy cheap. Do you understand that much? Please tell me, there are two companies in front of you. One company has value of 2,40,000, one company has a value of 1,80,000. Can you please tell me which company has a higher value? 2,40,000 levered company has a higher value. What you should do, you should start selling those shares. Whatever is overvalued, you start selling that. So when you sell something, the supply increases. And when the supply increases, what happens to the value beta? The value will fall. You start buying something which is undervalued. When you start buying something which is undervalued, what will happen beta? Can I say demand increases, so the prices will increase. So eventually value of both the companies are going to what? Be the same. The value of both the companies are going to be the same. And when value of both the companies be the same, na beta, and if the EBIT is also same, then don't you think that the KO will be remain constant? So even MM supports the view that even if there are different capital structures, but the value of the company remains the same. Right now it is not the same, but people will exercise this arbitrage opportunity, and because of that the value will remain the same. And there are many assumptions MM makes in proving this arbitrage. Okay, so I will explain you this with the help of the question itself, which is also a study module question. Just check this question, question number 6. Now I'm doing MM approach. Okay, there are two companies N and M having the same EBIT of rupees 20,000. Okay, how many companies are there, everyone? Two companies N and M. Okay, now the EBIT is the same. What is the amount of the EBIT, guys? EBIT. What is the amount of the EBIT? Come on here. EBIT is 20,000. So EBIT is 20. Everyone, hello. EBIT is 20,000. Acha, from EBIT, what do we subtract, everyone? What do you get? Is this EBIT also called as your dividends? Come on here. What is the amount of interest? First of all, M Limited is a levered company. M is a levered. N is an unlevered. Okay. Levered company means what, beta? Having debt in the capital. Now, can you all please tell me what is the amount of the debt? 1 lakh. Okay, Mr. Ish, what is the rate of interest? 7%. Can I say the amount of the interest will be 7,000? So 20,000 minus 7,000. Can I say this is 13,000? Unlevered company beta, is there any debt in the capital structure? So this will continue to be what? 20,000. Are you all okay with this much part first? This is 13,000, this is 20,000. Okay, this part is clear. Now can you all please tell me what is the cost of equity given for N Limited? 10%. What is the KE given for N Limited? 10%. What is the KE given for M Limited? 11.5%. Are the two companies having two different KEs? Come on. Yes or no? Yes, sir. Because both the companies have different element of risk. That's why expectation of equity shareholder is also different. What is your debt? Where is your debt? Is the debt there in N or the debt is there in M? If the debt is there in M, can I say risk is higher there? And the risk is higher, equity shareholders expectation will also be higher. So that's why don't you think that the KE is also higher there? Right? So the KE there is 11.5% and here the KE 11.5 and 10. Shriram, you tell me how do you calculate market value? Very good. What is market value of company? Once again, market value of debt plus what is the market value of debt? Just check. What's the market value of debt? 1 lakh. But that is only available for M. Okay. What is market value of equity? How do we calculate market value of equity? Now there is no need for question. Just look here and tell me. How do you calculate market value of equity? Dividend upon KE. You can capitalize and you can, right? What's the amount of dividends, guys? 13,000. If I take 13,000 and divide that by 11.5%, how much will I get? 1,13,043. Right? So this total will be what? 2,13,043. This is the market value of which company, beta? Levered or unlevered? Levered. How will you calculate market value of equity? Is there any market value of debt? No. But how do you calculate market value of equity? We take your dividends and we capitalize that by K. What's your dividends? 20,000. The moment I capitalize that by 10%, what is this going to be? 2 lakhs. Bolo yaar. So can I say now this is going to be 2 lakhs, beta? Yes or no? Yes, sir. Everyone in one voice, please tell me which market value is higher? Levered company value is higher or unlevered company value? Okay. Can I say that levered company is an overvalued company and this is your undervalued company? Do you all agree with this much first? But what was telling? Was telling that value of both the companies should be same. But I can't see that. I am actually seeing that market value of levered company is much higher as compared to the market value of unlevered company. So I can't see this particular thing. That value of both the companies are same. Are you understanding? So I told where is the value same? The value is different. Said, don't worry. Every investor will exercise arbitrage profits. And for that, they will start selling dash companies overvalued. They will start buying undervalued companies. Will for sure earn. Madam, you pay attention. You have lost the track completely. Huh? What happened to you? Bhagwan, shall I dance and teach? Want coffee? Sure? Hiccup. Because I am seeing students and then I am explaining. Na? So I am seeing some students and I am feeling demotivated. What is your name? Sadhna. You have to study. This is approach. In approach, you can't take this risk. You guys okay? You're okay? You want coffee? Shall I order for everyone? You're not going to get also, okay? Okay, but you have to focus. Sadhna, you only tell me, chal. Which one is the overvalued company? Which we are doing FM, okay? We are doing FM. This is approach, okay? Okay. My name is Bhavin sir, and these all are your students. I'm not students. So tell me, which one is the overvalued company? It's a no-brainer. I've written here, okay? I deliberately asked you something for which you don't have to apply your brains. Which one is the very good, beta, stretch. Some people are like, online students, you guys are there? Online? My dear online, look at the reaction. Look at the reaction. I'm so proud of you. I'm so proud of you. Very good. Very good. Thank you. Look at the reaction. And here people are stretching. Okay, no problem. You know, there are students who have that they can sleep with their eyes open. I'm telling you that. I've seen, they will see like this. It seems that they are looking at me, but they are already there somewhere. You know, they are somewhere, they're lost in their own world. And then when, have you understood? Huh? Of course. Why not? I have only created And Sadhna, your partners, this side, Shriram, I know, huh? Sorry? Vittal. Vittal, how do you say yes? Matlab, you know what is Vittal doing? Have you understood? he doesn't do like this. You know, he keeps on doing like this only. When I look at Vittal, I have a self-doubt. I told him, will the KO increase? He gives correct answer. Huh? Yes, the KO will increase. But he doesn't do like this. Many people have the habit of doing like this. This is not their yes, this is their yes. Vittal really does that. Vittal yaar. Huh? What? People have different talents here. And you know what was Sadhana trying to do? She was trying to hide behind slightly she was trying. Because the moment I started approach, she understood that now the time has come that I should slightly slide in a way. Owl's partner window seat. I have eyes on you also. Okay. Madam has kept the bottle ready. Very good. Okay. Coming back to this. Can you all please tell me, is there any overvalued company? Come on, yes or no? Yes, sir. Sadhana, tell me which one is the overvalued company? It's a very difficult question. Okay. But still, which one is the overvalued company? M. Very good. Okay. Is M an overvalued company? Yes or no? Yes. Which one is the undervalued company, beta? N. Obviously. So, an investor should start selling which company shares? M. Overvalued company shares. Na? When the investor will start selling overvalued company shares, then they will start buying what, beta? Undervalued company shares. And in pursuance of that, they will earn some arbitrage profits. But they have not told you that who is the investor, where is the investor. They have not given you any such kind of data. So we have to assume like this. Let's say Mr. Vittal has 10% stake. Mr. Vittal has what? 10% stake in Yum Limited. That is levered company. Okay. So Mr. V has how much percent stake, beta? 10% stake. In which company, beta? Levered company. Okay. It has 10% stake in levered company. Alvar, you tell me, if he has 10% stake in the levered company, it means that the total market value of the equity is 1,13,043. And how much percent stake does he have? 10%. So can I say that his total stake value is 11,304, beta? Come on here. What should he do? He should buy more stake or he should sell the stake? Sell, na? If you sell something, then will you receive money? Come on, yes or no? So the sales proceeds. What is the sales proceeds when you sell this stake? 11,304. How much money, Sadhana, you have in your pocket? What will you do? Party? Arre, very good. Buy shares of which company? Undervalued company. You should buy shares of undervalued company. Very good. But you know what? That the risk is not the same. Don't you think that levered company has debt equity both in the capital structure? And unlevered company do not have any debt in the capital structure. So you know what? You cannot go and tell the unlevered company, please go and take debt. So what will you do? Who will take the debt here? Then it is the investor who will take the debt. So who is going to take debt here, beta? Unlevered company will take the debt, or who is going to take the loan, beta? Investor. Who is investor? Vittal. So we will tell Vittal take some loan. Vittal is like, I have already sold some shares and I have the proceeds. Let me invest that. They are like, no, take some loan. Take some loan. He's like, but why? Well, says take some loan. You know, there was one game, Simons. Then your Simon says clap your hands. Then you have to clap your hands. Are you understanding? Simon says stand up, then you stand up. You have not played that? So something like that. MM says take the loan. So Mr. Vittal, do you have to take the loan? Come on, yes or no? Yes, sir. Okay. In the same proportion of what levered company has taken. There's a logic behind this, but we don't have that time. But we have to maintain that same risk appetite. So who will take the loan, everyone? Investor. Investor will take the loan. So Mr. Vittal, he just wanted to buy the shares of unlevered company. But Sadhana told that, wait, unlevered company does not have the same debt equity of what levered company had. So take the loan. Vittal is like, okay, I'll go to the bank and I'll take the loan. How much amount should he take? Then can I say he should take the loan which is in the same proportion of levered company? Can you all please check? Levered company has debt of what? 1 lakh and equity was 1,13,043. So what was the debt? 1 lakh. What was the equity? 1,11,000, 1,13,304. 113,043. Okay. How much? Now, how much is the equity he had? 11,304. So, of course, the proportion of debt will be what, beta? 10,000. So, now he has to take 10,000 rupees loan. So, now what is the total amount available with him? What will he do with that? Party? Should Mr. Vittal party with this 21,304? What he should do? Invest. Invest where? Now, when he will invest in unlevered company, so now he is a shareholder of Dash, unlevered company. Of course, na, because now he has bought shares of what? Unlevered company. Divya, what Mr. Vittal should do? He is now already a shareholder of unlevered company. So can I say he is going to receive dividends from unlevered company? Chalo yaar. Unlevered company. What is the dividend of unlevered company? Just check here. What is the dividend of unlevered company? How much? Arey, unlevered company dividend. How much? 20,000. Barabar? Will he receive full dividend? Boss, will he receive full dividend? Or he will receive up to the extent he has invested? Up to the, arey, of course, yeah, if I have bought 5 shares of Reliance, I cannot go to Mukesh Ambani and tell, give me your 200 crore rupees dividend. Can I get full dividend, beta? No, I don't know. Arey? If you are, if said no. But what is no like this? Will you get full dividend? You tell me, bacha, what is the dividend? 20,000. Are you going to get full dividend? No. Well, this is no. Okay. Will you get dividend up to the extent you have invested? Come on, yes or no? How much have you invested, beta? 21,304. Okay. Can I say if the market value of equity is 2 lakhs, the dividend given by the company is 20,000. But you have invested 21,304. So this should be how much? You cross multiply. Huh? 2130.4. Now how do we come to know there is arbitrage profits? 21,304 is the dividend which who is receiving? Vittal is receiving. Because he has shifted from where to where, beta? Levered to unlevered. So he has got 2130.4 as dividend. But from this, now you also have to subtract some dash. You have to subtract some interest. Why do you have to subtract interest? Because you have taken loan. How much amount loan you have taken, beta? 10,000. What is the rate of interest? What is the rate of interest? Look here, look here, look here. What is the rate of interest? 7%. So can I say he has taken the loan of 10,000 where the rate of interest is 7%. 700? Come on here. He has taken the loan of 10,000. The rate of interest is 7%, right? So 700. 14.4. Barabar? But now this is the net dividend he is going to receive from unlevered company. Now, Mr. Vittal is wondering, why have I done this exercise? Why have I done this exercise? I have received 1430.4 dividend. It's okay. But why have I done this exercise? You know why he has done this exercise? Because he wants to earn something more. Why do we shift from one company to another company? Only when we get something more, right? Come on, yaar. So he wants something more. Okay, can you all please tell me what was his old earnings? His old earnings was 13,000 multiplied by the stake. 1,300 was his old earnings because you are having 10% stake. So from this, if I subtract opportunity cost, what is the opportunity cost? Dividend lost from levered company. That is 1,300. Please tell me, are you earning something extra? This 130.4 is called as arbitrage. Thank you. She just did like this and then she stopped. Well, one is enough for you for arbitrage. Okay. Alvar, have you understood this, beta? Is there any arbitrage profits which is getting derived here? If the arbitrage profits is getting derived, will the people try to generate this arbitrage profits? Come on, yes or no? Yes. And for that, what they will try to do? They will start selling dash overvalued company shares and they will start buying dash, and for sure they will earn some profits, and those profits are called as arbitrage. Simple. Have you all understood this? So when you start selling overvalued company, the prices will fall. When you start buying undervalued company, your prices will increase. There will be a point in which there will be equilibrium. The value of both the Any doubts, beta? Purinjida? Koncham Mottam? Mottam is full, na? I think. I don't know. Saptingla? Saptingla? That seems because people are sleepy. They ate too much of Saptingla. And then they came. Because here, you know, it is on. Climate is also very good. And the voice is also very soothing. You feel like sleeping, right? I'll throw this bottle now, okay? Those who want to sleep. Online students. Online. Are you guys there with me online? Very good, yaar. Very good. Have you all understood arbitrage? Have you all understood arbitrage? Understood. Understood. Someone has understood air. Understood. Clear. Very good. What can be a second situation which is possible here? No. We are not playing opposites. But we have invested. Which one was your overvalued company? M. And overvalued was levered. And we shifted to undervalued. Which one was undervalued? Unlevered. Solu yaar. So we shifted from levered to unlevered. You know what is opposite position? We can shift from undervalued to same only, but now the overvalued company will be unlevered and undervalued company will be levered. That is one more situation. Now I'm not going to solve that, but I'm just telling you that if suppose we shift from unlevered to levered, there is only one change which we have to make. What is the one change which you have to make? Sadhna, in the first situation, did you take loan? You took loan. That's what I'm asking you. It's so easy to confuse. Did you take loan? Are you sure? In the first situation, did you take loan? But in the second situation, did you take loan, or now you have to take the loan, or now you have to give the loan? Because now you are shifting from unlevered to levered. We will give the loan. If you give the loan, you have to pay interest. What? Yes. When you give loan, you pay interest also. Very good, beta. Give me loan. Give me loan. Give me loan. Online students, you all answer in the chat box, because these guys, I don't know what has happened to them today. It is raining outside, but their brain is raining inside. I don't know what. What is not nice? Huh? I'll give you 5 hours break, but don't worry, okay? Sadhana is taking break from 9 o'clock in the morning. Hey, you tell me now, are we going to take loan or we are going to give loan, beta? We're going to give loan. So are you going to pay interest or you're going to receive interest? So now there will be less interest or there is going to be add interest. So that is the only change. Okay? And that should be in the same proportion in which you have taken. How did you calculate that loan taken? The same proportion. You're getting the same. Awesome, beta. Have you understood this? I've explained you all the approaches in capital structure. In revision, and that also one question each. But for that you have to Gauni. But if there is no Gauni, then I cannot help. Okay. Now tell me one thing. There is something which is also called as now approach with tax. Last thing, beta. Last thing. Okay. I know people are thinking in their mind that why these people have created these approaches. Last approach, approach with tax. Now yesterday we did something where we understood that what is better than what? Is debt better than preferential or preferential better than debt if the percentage is? Mohan, you're loudly yaar. Debt is better than preference share, na? Why do you think debt is better than the preference share? Because there is tax savings on interest which you will get in your debt which is not available in preference shares, right? So if a company has debt in the capital structure, if the company has debt in the capital structure, tell me, if the company has debt in the capital structure, it means that that company will enjoy tax savings on interest. On here. So when that company will enjoy tax savings on interest, what do you think its market value should be, lower or it should be higher? Higher than which company? The company in which there is no debt in the capital structure. Okay. So now says that whenever there is with tax rate now, then market value of levered company should always be greater than market value of unlevered company. Whose market value company will be levered as compared to market value of unlevered? And he says that with the help of market value of levered company is equal to market value of unlevered company plus debt into tax. Because debt into tax will result in your tax savings. Okay. I would love to explain this concept, but right now there is time constraint. So we'll just remember like this, that whenever there is market value of levered company which is required to be found out in with tax, will it value be lower or higher, beta? Higher than market value of which company? Unlevered company. Okay. To the extent of debt into. Rest all the other things are the same. But here we don't use arbitrage profit, because here it is not possible that market value of both the companies will be the same. Okay, under unlevered company we said na that market value of levered and market value of unlevered company will be the same. That was possible in no tax. Hello, under no tax regime we understood this, that market value of levered should be equal to market value of unlevered. But beta, whenever there is going to be tax na, then in this situation, you know what will happen? Whenever there is going to be tax, your market value of levered will always be greater than market value of unlevered. Okay. With this, my dear students, now I officially say that your capital structure theories is now complete. Okay. And now I'll give you a break, but not now. After 30 minutes, I'll give you a break, because I want to complete one small chapter, dividend decision. We'll complete dividend decision and then we'll take. Okay. Dividend decision is actually very easy chapter. An institute will ask this chapter for 5 marks. Okay. But you don't have to worry, because we'll be covering all the dividend decision policies as well. Where is dividend decision? This is dividend. Okay. Online students, have you all understood? Online. Check. Check. Shall we proceed with your due permission? Hello? Or what happened to you? Did you understand capital structure theory? Very thoroughly. You understood cost of capital also. Every adjustment I've explained you which had some element of importance in that. Then we also did capital structure chapter EPS, indifference point FBP. We did leverages also. And we also did ratios also. The time has come that now we have to do dash. Dividend decision. Dividend decision. Shall we? Hey. Buy mode. Don't let. What happened? Buy mode. Now, dividend decision. Sadhna, now again, okay. 30 minutes. You'll get a chance to sleep. 30 minutes. What? Yes. I told now 30 minutes. You'll get chance. Yes. Thank you. In break, I'll be alive. Vital. Chalo. What's your good name? Last bench. Sorry. Dev. Dev, tell me, beta, if you are a CFO of a company, okay, who is Dev? CFO. Yeah, Dev. Now, Dev is a CFO of a company. Check. check. You guys are there with me? Online? Yes, sir. Online students, very good, beta. Online students are the best. They are not making any noise only. Okay. Because they are on mute. Okay. Anyway. Who was Dev? CFO. What was Dev doing? He was a CFO managing finance and he received some profits. There are some profits in the company. Suppose the profits in the company are rupees 10 lakhs. Profits in the company are rupees 10 lakhs. Now he has two options. Either he can distribute that by the way of dividend or he can dash in it. He can distribute that or he can retain. Because that completely depends upon dash. That completely depends upon what is he going to do with the amount of the profit. Suppose Dev has certain projects which are lined up that will give him the profits of, let's say for example, 15%. Okay, so he has some projects in which he can invest the profits and he is going to earn how much beta? 15%. He's going to earn 15%. So Dev is going to earn the profits of 15% on those reinvestment. But equity shareholders are expecting only 8% from him. So Vittal, equity shareholders are expecting how much? 8%. Tell me one thing. All are equity shareholders of Dev. Dev just called a meeting and told, okay, listen here, I have a wonderful project lined up in which I can reinvest this profits and earn 15% for you. And anyway, you are just expecting 8% from me. I have good projects in which the return generated is 15%, but you are just expecting 8% from me. Then everyone please tell me in one voice, what should we tell Dev to do? Should he distribute the dividends to us or should he reinvest it? Reinvest it. Why? Because can I say R is greater than KE? When the return is greater than KE, then don't you think that your payout ratio should be maximum or the payout ratio should be minimum? Minimum. And only then, when such kind of good decisions are made, what is the impact on the price of the equity share? The price of the equity share will be kept on increasing. Price of equity share will rise. If you make correct dividend decision, then price of equity share definitely rises. The price of equity share rises. This is something which is very, 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 very important from a CFO's perspective, because based on CFO decision, the price of equity share will be having an impact. Based on CFO's decision, the price of equity share will definitely be having an impact. The price of, because if he makes good decision, then on that particular cases, the price of equity share will rise. And if he makes bad decision, the price of equity share will fall. You guys trying to understand? Price of equity share is completely dependent on good dividend decisions by a CFO. You know, Microsoft, Bill Gates, instead of 2 decades, did not declare dividend. You know why? Because they wanted to expand and grow. What do you think happened to the profits of the company? Were they kept with the company itself and reinvested? Come on, yes or no? Yes. Because they wanted to expand and grow. Rather than distributing that by the way of dividends, they started reinvesting it and started earning profits of it. So equity shareholders also respected those decisions. And that's why it was not that the share price was constant. The share price was also rising. But if suppose a CFO in a growth stage on distributing dividends, then equity shareholders will not like it. They will start buying the shares or they will start selling the shares. Start selling the shares. So always remember that dividend decisions have an impact on the price of the equity share. Come on, yes or no? Yes, sir. Now, in this particular case, there are different approaches. Do you know there is something which is called as your Walter's model? Have you heard about Walter? This is called as Walter's model. This will help you to calculate what should be the price of an equity share based on your, dividend payout ratio. Then there is something which is called as Gordon's model. That is something to you anyway know. Then there is something which is called as approach. Look who's back. Then there is something which is called as Graham and Dodd approach. Graham and Dodd. And then there is Linter's model also. Usually Linter's model they don't ask, but they ask suddenly some 3 attempts before for 5 marks. Linter model. Okay. So we'll be studying each and every model fast and the application of the same. So apart from this, only Linter model does not have an impact. This model does not show how dividend distribution will have an impact on the price of the equity. Linter model has this disadvantage. What is the disadvantage bit of Linter model? That it does not show what is going to be the impact on the price. Linter's model is actually used to estimate the dividends at the end of year 1. So the formula is something which you just have to understand. It shows what is going to be the impact of price. What is the impact of D1, on the basis of different payout ratios. It does not show what is the impact of dividend on the market price. Linter model generally we don't use it to calculate the price. So it's unexpected. I'm not expecting it to come also, but you never know. But these 4 models, yes. Which one is the first model? Walter. Walter says that, okay, sir, I just need what is the EPS of the company. I just need what is the DPS of the company. I just need what is the R and I need K. If you give me these 4 ingredients, I'll tell you what is the price of the equity share. So, suppose, tell her that after it's okay. What is the EPS? Suppose EPS is rupees 10. The DPS is rupees 7. Suppose your R is example 20% and your K is 10%. Based on these 4 ingredients, what should be the price of an equity? So your P0 should be DPS plus EPS minus DPS into R upon K, the whole upon K. Can you give me DPS, beta? Chalo yaar. What is the EPS? What is the DPS? What is the R? What is the K? Capitalize it by 10%. So that's why this will be 3 into 2 plus 7 divided by 10%. What is the price, beta? 130. But let me tell you, is this the optimum price? Is this the optimum price? This is not the optimum. Bacha, you know why this is not the optimum price? Because you can just check that R is greater than K. Alvar, what is R, beta? So that is written. So how much is that? 20%. What is your KE, beta? Divya, can you please tell me what is R? 20. Matlab, if you have retained this profits and if you invest somewhere else, then you are going to get 20. But the expectation of equity shareholder is 10. What do you think you should do? Should you distribute dividends or should you retain it? What do you think you should distribute or retain it? When you have projects which can fetch you 20% and there are equity shareholders which are just expecting 10%, what do you think you should do, beta? You should distribute the dividend or you should retain it? So you know what should be the optimum payout ratio? What is the optimum payout ratio, everyone? It should be 0. There should not be any payout only. Optimum payout should be 0. You can't have a payout ratio. You can't have a payout ratio. Tell me, why can't you have a payout ratio? Because R is greater than K. If you want to maximize the price of your particular company, don't distribute even a single rupee by the way of dividend. Don't distribute it. So in that particular case, your DPS should actually be 0. And you know what? If the DPS is 0 now, in this situation, the price of the share will be maximum. Now what is the DPS which I have told you to keep, beta? 0. So can you please tell me now what will be the market price? This will be 0 plus 10 minus 0 into 20 by 10 upon 10%. So how much is this going to be, beta? 200. So what is better? When R is greater than K, then what is better? When R is greater than K, then what should be your payout ratio? Can I say my payout should be 0? Come on, yes or no? Yes. Then my payout should. You're trying to understand this? If R is less than K, then what should be your optimum payout ratio? 100%. That will give you the best price. This is what Walter tells you. But beta, what if R is equal to K? No matter what the payout ratio, the price is going to remain constant. Very good. If R is equal to K, if R is equal to K, do whatever you want to do. Hello? If R is equal to K, do whatever you want to do. Is the payout going to remain the same? Come on, yes or no? Yes. Matlab, your price is going to remain the same. So Walter has 3 approaches. What are the 3 approaches? R is greater than K, R is less than K, R is equal to K. If R is greater than K, then the payout should be dash. Solo. 0. If R is less than K, what should be the payout? And if R is equal to K, what should be the payout? Any payout ratio. Purinjida. Now, tell me, this was Walter. What does Gordon tells you? Can you give me Gordon's formula? Why are you getting so scared? Answer properly here. What will be the numerator? D1 by P0 into 100 plus G. We did this yesterday. Rahul. We did this yesterday, Dev. Now if I want to calculate P0, can I calculate P0? How? I can take G here. So this will now become what? K minus G is D1 by P0 into 100. If I take P0 here, what this will be? D1 upon K minus G. Must. Okay. But here the assumption is K should be greater than G. You know why K should be greater than G? Because if K is less than G, then can I say that this will become negative? And market price can't be negative. You go to buy something, they will not give you money and product both. He was giving me loan also and interest also. After the end of this session, I am going to take. How much? 1 crore loan? Like, okay. Take. Very good. So can I say K should be greater than G? Yaar, hello. K should be, and K and G both should be constant. Did you realize this? Now, this was your which model, beta? Gordon's model. Walter is done, Gordon is done. Then there is MM model. Now, MM model says that the value of the company remains the same. Value of the company remains the same irrespective of the payout ratio. Oh. What does MM tells you, beta? Value of the company remains the same irrespective of the payout ratio. Gordon and Walter are telling, what are you saying? Dividend policy decisions will have an impact on the price of the equity share. So what is MM telling? They might be having an impact on price of equity share, I don't know. But value of the company will remain the same irrespective of the payout rate. MM is always different. See, there also MM was very different. What did MM tell you? Modigliani-Miller approach. What did MM tells you in that? Market value of levered and unlevered company, first there will be overvalued, undervalued, and then there will be the same. Then he tells you that market value of levered company will be unlevered company plus debt into tax. Now he tells that whatever is going to be your payout ratio, it doesn't even matter, value of the company will remain the same. I'm like, what? He's like, yes. Well, prove it. He says that value of the company is N plus change of N into P1 minus I plus E upon 1 plus K. This is the formula which he has told. N plus change of N minus into P1 minus I plus E upon 1 plus K. This is how the value of the company. But what is change in N? What is change in N? Can I say new equity shares which are supposed to be issued? That's called as change. Minus I plus minus I. Can I say I is nothing but investments which is supposed to. And E is nothing but the earnings. And as you can see, the entire numerator is in future value. Because see, N plus change of N into P1. P1 is today or P1 is at the end of year 1. Investments made are to be at the end of year 1. Earnings are at the end of year 1. All this is in present value terms or all this is in future value terms? Future value terms. And all this is at the end of year. If I want to calculate the present value, what do I have to do? I have to divide by 1 plus K. That's how I'll be getting. Because whenever you want to convert anything from future value to present value, you divide by 1 plus discounting. That's how the formula is. I can derive this for you, but not now. Or else sadhana will go into deep sleep. Deep sadhana. But this is how you calculate what value of the company. This is which approach? Yum yum. Yum yum approach. Where is it? Yum yum. And then there is gram and dot. So gram and dot approach, that will have your P0. And he takes into consideration multiplier effect. So M into D plus by 3. How the formula is being the market. You can check it is in the new what? It. So still we'll make just make. They have asked one. Okay. These are the approaches. Okay. And Tinter I'll explain you later. But all these 4 approaches, can you all see talking about what? Price. You know, this was talking about value. This was talking about price. This Gordon also talks about price. Right? So everywhere we are talking about price. Only Linter doesn't talk about price. Talks about dividend. Okay. Now everyone come to this question. Please come to this question. Which question? I'll solve one question. This. We'll solve this question number 3 because in this question now, R is something which we have to calculate and even K needs to be calculated. So both the question needs to be calculated. That's why we are solving this. Okay. Are you guys tired? Are you guys tired? There is your energy, guys. You answer properly now, okay? In Walter model, R is greater than KE, the optimum payout ratio. Very good, yeah. When R is less than KE, the optimum payout ratio should be. But when R is only not given and KE is only not given, then what should we do? We have to calculate. I'm deliberately taking this in which you have to calculate R and K. Hey, Gaune. The following information is total earnings is number of equity shares is 20,000 of rupees 100 each. Everyone in one voice. What is the equity share capital now? 20,000 of rupees 100 each. Solu yaar. 20 lakhs. Can you give me the earnings, beta? 2 lakhs. Guys, if the earnings is 2 lakhs and the equity share capital amount is 20 lakhs, can you give me R? Can I say you have earned a return of 10%? Yaar. Your R is 10%. What is the dividend paid? 1,50,000. And what's your price earning ratio? 12.5. Guys, can you please tell me P ratio formula is MPS by EPS. So can I say if I take this here, PE ratio can also be 1 by EPS by MPS. So 1 by EPS by MPS is nothing but KE ratio. This is nothing but KE. Okay. Earning yield approach. Can you recollect earning yield approach? Earning yield in that cost of capital. Yesterday you all were not there. But in that KE, do you remember earning yield approach? Sriram, we had done dividend yield growth, CAPM. And can you recollect in your earning yield, we took EPS by MPS. So that was nothing but KE. So can I say P is 1 by KE? Arey, hello yaar. And if P is 1 by KE, what is KE? 1 by P. Do I have P? Solu, do I have P? Can I get KE? Everyone on your calcs. Everyone on their calcs. What is your KE? What is the KE, beta? It is going to be 8%. Solu, yes or no? 1 divided by 12.5. 0.08, matlab 8%. Now, because you all are intelligent, tell me, what is the R which you got? What's the KE which you got? Is R greater than KE? Mr. Dev, if R is greater than KE, what should be the optimum payout ratio? Optimum should be 0, but these guys are mad. Why? Because the dividend paid is what? 1,50,000. They should actually not. Okay, but they have paid the dividend. That's what they have asked. Ascertain whether the company is following an optimum dividend policy. Amma ille. Company is not following. They should follow. If R is greater than K, then the optimum payout ratio should be 0. Okay. Find out what should be the P ratio at which the dividend policy will have no impact on the value of the. When will the dividend policy have no impact on the value of the share? When R is equal to KE. What's your R? R is 10%. So your KE should also be dash. Only when K is 10%, I can say that it will not have any impact. Come on, yaar. So for dividend policy to have no impact, your R should be 10. Your KE should also be 10, yaar. What is the formula for P ratio? 1 by KE. 1 by 10%. Can you give me 1 divided by 10%? 10 times. So what should be the P ratio? అర్థమైందా తెలుగు అల్వార్ చెప్పండి. If the P ratio is 8 instead of 12.5, if the P ratio is 8 instead of 12.5, can you please tell me what should be your KE? What should be your KE? Because 1 upon 8 will give you 12.5, yaar. 12.5. Now tell me, what is your KE? 12.5. What's your R? Your KE greater than R. If KE is greater than R, then what should be your decision? 100% payout ratio. The market. Okay? Purinjida? Okay. Now I will do one question on Gordon. Okay? Gordon. One question on Gordon, then we'll take a break. Solve this. But genuinely tell me, are you getting some value addition to your finance knowledge? Adna is telling yes. Doubt. Much of knowledge that I'm sleeping now. No? Are you understanding different perspective, and your concept should be more clear. I'm trying to explain you as much as possible. Online students, I'm asking you also this question. Pranavi, Archana, everyone, Abhinav, Aarti. Finance is very interesting. Fortunately, for 50. In that also 50. So much to do for 35 marks practical. I hope you're understanding. Concepts are very important. Chalo. Now let's continue. Last question. What is given? Alvar. ANR is a large multinational company. Where is it listed? BSC. With a face value of rupees 100. The expected growth rate is 15% for the next 4 years and then 5% for an indefinite period. So when is the growth rate remaining constant, beta? Is the growth rate remaining constant from first year onwards, or growth rate is remaining constant from 5th year onwards? You always remember that Gordon says you can only apply my formula, when the growth rate is constant. If the growth rate is constant from first year onwards, as all the other questions, we used to calculate Gordon's formula from year 0 itself. But if the growth rate is constant from 5th year onwards, I have to calculate the price at the end of the 4th year. 4th year. If growth rate is constant from first year onwards, I calculate P0. Bolo yaar. If the growth rate is constant from the first year onwards, I can calculate P0. If the growth rate is constant from second year onwards, I can calculate P1. Price at the end of the first year. If the growth rate is constant from third year onwards, I can calculate P2. If the growth rate is constant from 4th year onwards, I can calculate P3. If the growth rate is constant from 5th year onwards, can I calculate P4? Come on, yes or no? Yes, sir. I can calculate what? P4. What is the formula for P4, everyone? D5 upon KE minus G. Okay? And then they have told you that the company has paid. Achha, the shareholders expect 20% return. This is called as your KE. And the company paid rupees 120 dividend per share. Can I say when they use the word company paid, is this your D1 or this is your D0? This is your D0. And the shares of the company are traded at an average price of 3122 on the last day, and find out the intrinsic value and whether the shares. So we are required to find out the intrinsic value. Intrinsic value means value of an equity share. How do you calculate value of an equity share? So what you do is you take what are the benefits which you are going to receive from this company, and then these benefits I will discount it. Okay, the benefits which I am going to receive will be your dividends, okay, and the market price, and this is something which I will discount it at the equity shareholders expectation. What are the equity shareholders expectation? 20%, and this will give me my present value. So this is what I'm going to do. You know, capital budgeting and investment decisions, you all must have studied this, that whenever you want to find out the present value, what do? We estimate future values, we discount it, and we bring it to present value. Simple, na? We have to estimate future value, and then what we have to do, we have to discount it, and we have to bring it to what? Present value. Always remember that what is the present value? Future value, cash inflows, discounting and bringing it to present value. You know this, this is normal, right? In investment decisions, you almost have studied earlier. Now, can you please tell me what is going to be the future value benefits? Can I say the future value benefits will be in the form of dividends? Is dividend your future value benefit? Come on, yes or no? Yes, sir. Dividend is your future value benefit. Everyone in one voice, please tell me, what is the dividend which the company has just paid? 120. If you are an equity shareholder, if you invest in the company, then you will be getting last year dividend or next year dividend, beta? Next year. And next year dividend will be what? 120 plus the growth rate. What is the growth rate, guys? What's the growth rate? 15%. So the growth rate is 15%. Can you please give me 120 plus 15? 138. What is 138? Can I say this will be the future value of cash inflow which I'll receive at the end of year 1? From 138, if I add 15%. 158.7. This is year to cash inflow. 158.7 plus 15%. 182.505. Then 182.505 plus 15%. Can I say all these are my future value of cash inflows which I'm going to receive? Come on, yes or no? Yes, sir. Then my dear students, you also have to calculate P4. What is P4? D phi upon KE minus G. Do I have the D phi? I can calculate it. What is the D4 beta? 210. So 210 was the dividend at the end of the 4th year. So for 5th year, what do you think my dividend will be? Can I say 210 plus 5% upon what? KE minus G. What is this answer going to be? 210 plus 5%. Divide that by 15. How much is this going to be? 1470. Now what should I do? I should discount all this at 20%. I should get the present value. And then I will compare this present value with the actual market price. What's the actual market price? 3122. Suppose, I don't want the answer for this, but suppose the present value of this comes as 1500. Example. Okay, and what is this beta? 3122. So what is your value? What is the present value of cash inflows? Present value of cash inflows 1500. And what is the market price of the equity share today? 3122. What do you think? You should invest or you should not invest? Not invest. Why? Because according to you, what's the present value? 1500. Arey yaar, according to you, what's the present value, guys? 1500. According to you, the present value is 1500 beta. Okay. But the market price is 3122. Will you invest or you will not invest? That is called as overpriced. And if the price is, let's say 5,000, and if the market price is 3,200, will you invest or you will not invest? Invest. Because according to you, the present value of cash inflow is greater than what should be the price. Are you understanding this? So this is what we are going to do in this. Now we'll take a break. I'll see you in 15 minutes. Okay? With MM approach and then the other part. So let's take a break of 15. Okay, have coffee, tea, then come. Okay.